Hey, good evening. I'm Dan Fitzpatrick at StockMarketMentor.com, and it's Thursday, May 7th. We're looking at SHAK here, and this is why. This was a short squeeze. A lot of folks had been talking about it. I know Kramer had been, he's talking about it on Squawk on the Street in the morning. I've seen guys on Fast Money talking about it. I've been talking about it. I think here in my free chart videos, but definitely on our subscription site, that this is a short squeeze. Okay, nothing against Shake Shack. I've never eaten there, but I'm sure their shakes are really good. But this was a short squeeze. They have a PE. Now their revenue growth over the last 4 quarters, respectively, was 54% increase, 32% increase, 40% increase, 52% increase. So the revenue growth has been impressive. That's what we like to see. And the market will pay up for strong revenue growth, like to stupid, ridiculous PEs, especially now because a lot of companies aren't growing that fast. So the market will, in other words, you're going to get stocks of companies with strong revenue growth, and then you look at the PE and say, for crying out loud, this is just stupid. But yet the stocks keep going higher. You have to understand, though, when that's happening, how much is short interest a key? How much is short interest a key factor in that? So I'm just looking now at Shake Shack, the shorts as a percentage of their float, 34%, and I'm pretty sure that used to be higher. So shorts are taking some of their stuff off. But my suggestion was the other day, and I sent this out in a morning note, you need to be getting out of this one and also taser, or at least lightening up, at least putting your stops in place. Now, the PE for Shake Shack is 939. That's only 55 times the average S&P stock. So obviously, this stock is trading at a premium. Now, how many people, other than some chucklehead who's running a money management company who's all upside down in Shake Shack, how many folks do you think are going to say, wow, Shake Shack is really cheap at a PE of 939? Okay, even with revenue growth like this company has been reporting, that is a massively ugly PE. And this is what you got to understand. This, and I'm giving you pearls here. Hopefully we'll be giving you dollar bills. This company reports earnings on Wednesday the 13th. This is a stock that's going completely on revenue growth, sales. And not just sales. Oh, they have strong sales. No, the market wants to see not just revenue growth. It wants to see accelerating revenue growth. Not just 52%, not just 40%, not 32%. It wants to see growth more than 52%, which again is just the last quarter ended December 31st. So if this company reports earnings growth that's not like absolutely blow them out of the water results, you could see this stock fall further. And you can say, oh, well, Dan, how could it do that? This is a buying opportunity. It's already fallen 15%. Look, there's no law against a stock falling back 55%. There's, down to $55. You just can't tell with a stock like this how far down is too far down. So my suggestion to you is stay out of this stock until after the company reports earnings. If you're in it, that's fine too. Just make sure you're grabbing your seatbelt. It's a contact sport. I've said it before. I'll say it again. Wear a cup.